Hello, 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 and happy Friday. I am back for yet another live event where we unpack the complexities of multifamily underwriting and various aspects of passive investing, one step at a time. For those who may be tuning in for the first time, my name is Vessi Kapulian, former commercial lender turned real estate investor. And today I work with family offices, high achieving professionals to in two ways. One, to help them vet the deals that come across their desk and help them navigate through the complexity of the underwriting, the deal structure, and so forth. And for those ready, willing, and able, I connect them with passive cash flowing opportunities in real estate. I also work with investors relatively new to multifamily who want to learn how to underwrite deals so they can analyze them with confidence and ease, and most importantly, protect their capital. Now, today's topic is one that I found particularly interesting, and it covers again both underwriting and passive investing, and namely the impact of rent declines as well as certain limitations on other income that some states are and will be implementing. And before that, I just wanted to share on a personal note that I'm really, really excited. I promised myself that when I uh, reach a certain milestone, I will get myself a really nice mic, and you may actually see it. May see a little bit of it here in the background. So let me know in the comments if the quality of the sound is better or about the same relative to prior live events. I'm literally testing it with this live event, but was very excited to reach this milestone right in time for Thanksgiving and Black Friday. So literally just plugged it in before the live. And speaking of live of Thanksgiving and Black Friday, Cyber Monday, I actually have a special promotion that I'm offering to those willing to do a deeper dive and learn how to underwrite apartment deals from beginning to end. It's 50% off the course and the community. I can guarantee you one thing, that there will not be a sale like that in the near future when the promotion expires after Cyber Monday. And because I want to maintain the quality of the community as well as the quality of the interaction, again, it's me and the students interacting directly. There are no other intermediaries or people handling the communication. And because of that, I want to be intentional with my time and keep the group small and tight. I'm only opening 5 spots, and we still have a couple left, but I've already had the pleasure of inviting new people to the community. So, if that's something you're interested in learning and getting a head start on 2026, now would be a great time to join. And if you have questions, simply send me a DM. Now, back to the topic, underwriting deals when rents decline and restrictions on other income appear. It's been a very turbulent year for multifamily, and if you were reading any of the press or even following me at the beginning of the year, I think there was a consensus among many of us in the industry that the volume of deals will be increasing materially. And a predicament for that was the wall of maturities coming up, the declining supply in apartments. All in all, the fundamentals for multifamily were shaping up to be really strong, and they still are in the long run. However, we've had a few tailwinds. First of all, with the remaining supply overhang coming on board, the demand has not been as strong to absorb it for a variety of factors, and I'm happy to do a deeper dive into those in another live. And if you do want to hear about them, please let me know, and I'll definitely make sure those are covered. But very high level, the tariffs, the new immigration policies, the new administration policies on various housing and social programs, all in all, resulting in severe competition for tenants or residents. And it's not uncommon in many markets, especially those impacted by the supply overhang, but not only those, to see rent concessions and in many cases also rent declines. And in fact, Real Page not too long ago published an article. They produce quarterly reports. So for their latest quarterly report, they indicated that third quarter rent declined by 0.3%, and the annual rent change has been negative 0.1 versus positive. And depending on the market, sometimes these rent declines are 8%. And so, or even higher, right? And relative to flat to improving and or even increasing rent growth that many people expected based on how trends were shaping up at the end of last year, early 2025. So those expectations have not materialized, and rent declines have been stickier or hanging around for a little bit longer, which then raises the question for anyone acquiring a property or for passive investors looking to invest in multifamily. Well, how then do you evaluate those deals? Because the upside of a deal is especially in the value add space, and I just want to clarify that's the area I will talk about today, although the comments I will make will definitely be relevant for new construction or new development projects. So, as we all know, when you evaluate an opportunity in the value add space, typically uh, uh, because of certain projects, whether it's bringing rents to market, optimizing expenses, improving the units, you're creating that value that effectively gives the operator the ability and opportunity to increase rents. We all know from prior lives, or if you followed my content, right, everything flows from the top line down. And so when the top line improves, that flows through the bottom line. And ultimately, that improved operating profit results in higher valuation, because that's how apartment deals and commercial deals are valued at the end of the day based on the cash flow that they produce. And so those recent trends in 2025, and again, I say recent because the trajectory has changed, right, from going up to actually declining, is raising the question, well, how do you evaluate these deals, right? And at the end of the day, you want your assumptions to be realistic. And is the deal going to pencil out if you project rent decline for the first year? Probably not. And I was even speaking at investors yesterday. I was at a family office conference, and one of the lenders were saying, well, we thought we were conservative by assuming a flat rent growth for the year, and in reality we've seen a rent declines. And again, that's across markets. Some markets are faring better than others. Uh, what's also complicating things a little bit in terms of gauging the trends, because normally you would say, well, talk to your property manager, study the comps very closely, and see where rents are headed or where rents are trading. Look at the trade up reports and all that level of detail, study the rent roll in a lot of detail, and that's all great. But what's complicating that exercise lately to make things a little bit more spicy are the revenue management software programs that effectively adjust the rental rates based on local market supply and demand. So effectively it implements dynamic pricing, and that could be a good thing if there is not a lot of supply and you want to take advantage of a little bit of a margin, but it could also hurt you. And so when you study a rent roll, it's really difficult to tell, oh, is that $200 or $300 upside in rent or rent increase that I see, is it really sticky, or is it because something happened on that day or that week to cause the supply and demand to fluctuate? And so that makes the exercise even more challenging, namely to nail down the rent columns that you then use as a basis to project the rent. And so I would always advocate for realistic assumptions versus optimistic assumptions. And the result of that exercise, of course, could be the deal is not penciling out based on the trends that we see today, based on the underlying supply and demand dynamics, and especially if you are not 100% certain, i.e., in cases where you have the interference, data interference with that revenue management software program, it's always better to err on the more conservative versus more aggressive side, which naturally may result in maybe negative rent growth in year one, flat in year two, and then eventually you start getting to your pro forma. Um, Another complication, just to throw even more spice in the situation, is that certain states are now passing legislation to limit certain other income line items, whether it's application fees, whether it's pet fees, late fees. Again, a lot of that depends on the local jurisdictions, the cities and states. So, working with a property manager who is well versed in that local regulatory environment is extremely important. Working with an operator who has boots on the ground and deeply understands the market to catch those local nuances is extremely important. But that then raises the question oftentimes, right, as investors, when we acquire properties, one of the ways we can add value other than bringing rents to market is creating other income streams. And so if that's no longer viable, it makes an upside in the achieving an upside in the top line even more challenging. So it's important to understand what those limitations are. And if someone is coming to you, if an operator is coming to you stating, hey, we're going to add pet fees in 100% of the units, you may want to ask a question, well, is that feasible, or even is that even going to be allowed? Are there any caps or limitations on that? And so the challenge that creates for investors and operators is, okay, well, how do I really add value to the property? How do I really improve the valuation? And really, that puts a lot of pressure on expenses, optimizing expenses, and especially in cases where the value add could be operational versus top line specific, where perhaps maybe they're not, the prior owner is not running the property as efficiently. There may be utility reimbursement tools that you can implement. Maybe they're not optimizing their marketing spend, maybe certain contracts when it comes to contract services or maintenance can be renegotiated and or trimmed to the extent that service is not really creating value. So it really requires laser focus and literally going line by line to see, okay, if we cannot, if we think in the long run rents will come up within that first year or two while we're turning the property, are there other activities or actions we can take to optimize the bottom line, and really through operational expertise and careful expense management, can we hold the line and profitability steady? So definitely not easy to accomplish, but it's important to do so, because at the end of the day, as investors, we want to protect the downside risk. One of my favorite questions to ask when I analyze deals is, why should I not do that deal, or what could go wrong? And that's an important question to ask for anyone, to anyone, because especially in the current environment, yes, anyone can make a deal look very pretty on paper, but are these numbers realistic? Because if they're not, the outputs are going to look very good on paper, but may actually make you cry in reality. So that's it for today. I just wanted to share my thoughts on the subject, but also how I will be approaching or updating um, my process for analyzing apartment opportunities. And what I just shared applies definitely to other asset classes, even to new construction projects, because again, those really hinge on the upside in rents. And unfortunately for developers, oftentimes they're looking 2 3 years out, and nobody has a crystal ball. But it's important to keep those current trends, or rather the lag in trends in mind, because that impacts timelines, expenses, and whatnot. So if you do have questions, you're always welcome to send me a DM. And again, if you're looking to start the year strong and take charge of analyzing deals and learning how to vet them and sift through the noise with confidence and ease, I would like to invite you to take advantage of the limited time offer that I shared at the beginning of the pop up live event. I will post a link in the comments so you don't have to look for it. And if you have any questions about the program, feel free to send me a DM. You're also welcome to go to masteringmultifamilyunderwriting.com for more information and to read about the success stories of many of my students. With that, I wish you an amazing Friday, an amazing weekend, and I will see you next week.